Welcome to the Wealth Wisdom, where knowledge becomes power and power builds your future.
Drones, not just toys anymore. The battlefield, the skies above cities. The world of unmanned systems is undergoing a massive shift. Today, we're looking into two smaller names that are positioning themselves for that shift. These stocks are in the drone, defense technology sector, and ISR, intelligence, surveillance, and reconnaissance space. Both claim progress and both carry meaningful risk. We're going line by line through their latest numbers, key deals, what they're doing, and what it could mean for long-term investors if things go well. Disclaimer: this is not financial advice. I'm not a financial advisor. This is just commentary. No hype, no buy or sell calls, just the facts and thoughtful commentary for you, especially if you're following money-mind finance or simply looking for interesting stories in the charts. Before we dive in, please take a second to hit the like button, share it with your friends, and also subscribe. Please help this video to get at least 500 likes. It really helps to support the channel and keeps us bringing you the latest market insight. Thank you. Let's start with the first on our list, Dragonfly, Inc., with ticker symbol DPRO. First, who is Dragonfly? Dragonfly, Inc. is a long-established drone solutions and systems developer doing hardware plus software plus services across sectors. Defense technology sector, public safety, agriculture, environmental mapping. They state over 25 years of innovation. Now the market context is critical. The global UAV unmanned aerial vehicle market is projected to grow massively. Some estimates go from tens of billions today up to $73 billion to $220 billion by 2032. What does that mean? It means a large addressable market if a company can scale. Also, according to Dragonfly, about 80% of U.S. public safety drones currently are foreign-made, which means there is increasing pressure for domestic mission-ready secure systems. Big horizon. So a company like Dragonfly that positions itself as a full-stack NDA-compliant North American LT provider could have a strategic advantage. Important to note, full stack means hardware, software, services. They claim a patent portfolio of 23 issued plus 1 pending and product lines, such as their Commander 3XL, Flex, FPV drones. So from a thematic point of view, defense plus secure supply chain plus drones equals trending. But story is one thing. Execution is another. So with that context, let's get into how Dragonfly is doing today financially. In Q2 2025, Dragonfly reported revenue of $2,115,255, up 22.1% year-over-year. Product sales were $1,491,585, up 37.1% versus the same period last year. So growth is there. The company is selling more product than before. That's positive. The cost of sales was $1.6 million for Q2, giving a gross profit of $514,590, up from $461,673 the year before, about plus 9.3%. Gross margin for Q2 2025 was 23.9%, down slightly from 26.6% in Q2 2024, even though product sales rose strongly 37%. The margin contracted a little. The company cites the sales mix of products sold as the reason. So growth is there, but margin pressure exists, probably due to product type or competitive pricing or cost structure. Operating expenses for Q2 were almost $5 million. The operating loss was $4.5 million for Q2 versus $3.5 million in Q2 2024, and operating loss per share was about 0.57. The company is still in an expansion burn phase. They're investing heavily, likely R&D, manufacturing build-out, sales, marketing, and not yet profitable. For many growth companies, this is acceptable, provided the growth can turn into scale. One of the more encouraging items is their cash balance. As of June 30th, 2025, it was $20.6 million, up from $6.2 million at December 31st, 2024. This jump likely reflects fundraising, which gives the company a stronger runway. Important for companies still burning cash. Growth, yes. Positive trend in revenue. 22% year-over-year. 37% product sales. Good sign. Margin dropped from 26.6% to 23.9%. Needs monitoring. Losses still meaningful. Operating loss burn continues. Cash runway improved. Strong plus. If you believe in the drone and defense technology story, you're seeing early evidence of traction. But you must also be comfortable with risk and time horizon, because this is not a stable income-generating business yet. On October 9th, 2025, Dragonfly announced a strategic partnership with Global Ordnance, a U.S. defense logistics agency prime contractor, to accelerate U.S. defense adoption of DPRO's platforms, embed manufacturing and supply chain support for mission-specific UAS. Dragonfly also entered collaboration with Palantir-like to enable advanced autonomous operations and swarming capabilities on Dragonfly's UAV platforms. On September 30th, 2025, Dragonfly was selected by the U.S. Army to supply its Flex FPV drone systems, first-person view, high-performance drones for U.S. forces. The company is getting into the right themes: secure domestic manufacturing, contracts, partners, advanced drone tech, swarming, autonomy. Those are all strong tailwinds if they can convert them into revenue and margin. Now we'll talk about the market environment and the risks, because every story has two sides. There is regulatory plus supply chain pressure for more North American-built mission-ready systems, especially in defense tech and public safety. That gives a structural tailwind to companies like Dragonfly, which brand themselves as full-stack, NDAA, compliant, U.S. manufacturing capable. In my opinion, the strategic partnerships and contracts suggest momentum. The biggest gap is between current revenue of $2.1 million for Q2 and the scale needed to fully exploit the market opportunity. If they don't scale, the tailwinds won't matter. As we saw, margins slipped slightly, heavy operating expenses. Manufacturing ramp-up can drain cash. They appear to have raised cash. Good. But if growth stalls, they may need more capital, which can lead to dilution. If you decide to follow a play like this, you ask, am I comfortable with uncertainty? Do I have a long horizon? Am I balancing this with more stable assets? Because if this succeeds, it's good, but if it falters, you cannot rely on it. Next is Red Cat Holdings, ticker RCAT. Red Cat Holdings is a US-based provider of advanced all-domain drone and robotic solutions for defense technology and national security. They have subsidiaries such as Teal Drones and FlightWave Aerospace. Their product family includes systems like the Black Widow Small Unmanned ISR system, the FANG FPV drone line, and they are branching into crewed surface vessels USVs with a new division. We're looking at a company that is not just playing in the hobby drone space, but trying to carve out a niche in military defense and government contracting. Exciting, but high risk. For a company like Red Cat, revenue today is often less important than backlog, contracts, certifications, and the runway they've built, but fundamentals still matter. They executed the TD3LRP contract with the U.S. Army to deliver up to 690 SRR Black Widow systems. This is huge. A government contract of this size can change everything. It means they're clearing a hurdle to be a serious supplier. Red Cat announced a strategic partnership with Palantir Technologies to integrate visual navigation software into Red Cat's Black Widow drones. They secured a $1 million contract for Edge 130 Blue drones from the U.S. Army's CECOM. They secured a TAC-5 contract from the U.S. Air Force validating FlightWave S-drone technology for mission-critical defense applications. They introduced FANG, a low-cost, NDAA-compliant line of FPV drones designed for defense. They launched Blue Ops for USVs, diversifying into surface drones. They announced a public offering of common stock, raising $150 million in September 2025. This raises cash good for runway, but also dilutes shareholders. So the narrative is strong. Defense tech contracts, certifications, new technologies, backlog, liquidity, but full of ifs. If they deliver 690 units, if they scale manufacturing, if they monetize FANG and USV, if defense budgets remain strong. Now the numbers. For Q2 2025, quarterly revenue was $3.2 million, very small. It signals the company is still early in monetization. Gross profit, a loss of approximately $375,000 versus a $267,000 loss year prior. The company is not yet positive on gross profit. Net loss from continuing operations was $13.2 million versus $8.1 million prior. Loss per share was 0.15 compared to 0.11. Heavy losses, as expected for a growth stage defense tech company. Red Cat ended the quarter with cash plus accounts receivable of $66.9 million, a bright spot. Strong liquidity gives them runway. Green flags, strong balance sheet, big contracts, NDAA-compliant products. Red flags, low revenue. Base, heavy losses. Dilution risk, execution risk. Red Cat guided for 2025 revenue of $80 to $120 million. That's a massive leap from $3.2 million in Q2. They also missed analyst expectations in Q2, expected 7.7 million, delivered 3.2 million. In my opinion, this is classic high-risk, high-potential territory. If they execute contracts, scale manufacturing, and deliver on guidance, this could be transformative. If they miss, volatility and dilution remain risks. Thanks so much for watching this deep dive into Dragonfly Inc. and Redcat. Disclaimer: this video is for informational and educational purposes only. It is not financial advice, and I'm not a financial advisor. Always do your own research before making investment decisions. Investing involves risk, including loss of principal. If you found this useful, please like, share, and subscribe. Have you looked at companies like Dragonfly and Redcat? Are they too speculative or an interesting horizon bet? Drop a comment and let's discuss. I'll catch you in the next video. Until then, bye for now.